Good afternoon. I hope you had a nice morning and are now fit to participate in my course. Well, what I will do in the morning is, well, in the early afternoon, sorry, I will give you a poll. And during that poll, I cannot accept people coming in. So those who are late, well, will not have the chance to take the poll. So they miss the chance to check whether they have a right understanding of what we did the previous day. So I will now open that poll, and before I will stop the recording, see the results. Okay, now you should be able to see the results. We did the poll on introduction to group accounting. So the questions cover what we did today. I'm sorry for those that were late, but I cannot let you in when the poll is going on. So you either have to be punctual or will miss the questions. So my first question was, why is group accounting becoming more and more important? Well, companies want to be seen as global players. Well, that's not exactly what is going on. Of course, they want to be global players, and of course, they want to compare themselves with other companies, with global companies. On the other hand, you are right. The consolidated financial statements are being prepared on IFRS. So when you really want to be a global player, you will have you want to be seen in an IFRS financial statements. So I think that this is a true answer. Then companies are growing internally, thus increasing mergers. Well, that's nonsense, because when you're growing internally, then you're doing the revenues from your own power, and you don't need mergers for that one. So that is nonsense. When you look at the next question, companies are growing externally. So they buy other companies, and that is why the merger and acquisition level is going up. So that one is a correct answer, and 100% of you got that right. So I'm very pleased to see that. Next question was, which statement is correct? Well, I said in 2021, because that will change, as we know. So in the first question, I said Vietnamese companies must not use IFRS in their annual report. Well, they are allowed to use it, but they are not forbidden. So that is a wrong answer, and I'm glad only one picked it. Vietnamese companies are allowed to use IFRS, yes, but not only. So they have to use VAS, that is compulsory, and when they want to add more information, they can do so. They are allowed to do that. So that is the correct answer. Vietnamese companies are required to use IFRS. Well, that's stupid. No, at the moment they are not required to use IFRS. They are allowed but not required. So Vietnam is already in the voluntary application phase. Well, that when you look at the decision of the Ministry of Finance, we are in the preparation phase, and so the next question was correct. Well, in the preparation phase, we can, of course, publish voluntarily IFRS financial statements, but The wording in the ministry decretion is that we are in the preparation phase. So Vietnam will enter the voluntary application phase next year, so 2022. And it will be compulsory for Vietnamese companies to use IFRS when they are using the stock market in 2025. So still some time to go. All right. So next question was, what does a group consist of as a minimum? And well, as a minimum, you have to have a parent and one subsidiary. So 79 got that right. And well, the others, please consider your question, your knowledge again, because maybe you misunderstood something. So you have to have at least one parent and one subsidiary to speak of a group. And group accounting, you only have to do when there is at least one parent and one subsidiary. Select the correct statement. Next one. Control is only measured by the majority of voting rights. Well, that's not correct, because it's not only measured by the majority of voting rights. There can be other means, like control can be exercised by means of the majority of voting rights or other contractual permissions or factual circumstances, which is the third option, and that one is right. I'm glad that 93% of you picked that. The other two are, well, let's look at the second question. Control is when a company has a significant influence. No, they have more than a significant influence. They have control, and that is more than a significant influence, is complete influence, so to speak. So that is a wrong answer. So only number 3 is correct. Question 5, which statement is correct? Joint arrangements can be split in joint ventures and joint control. Well, that's nonsense, because joint control is just a term how the control is organized. The term joint arrangement used by IFRS 11 is the overall term, and that will be split into joint ventures when the venturers have access to net assets, or joint operations when the operators have access to the physical assets and are obliged to pay the liabilities. So number 3 is correct, and the 2 other are not. Okay. You got that when, yes. Okay, so number 3 is okay. So statement number 6, with which statements do you agree? So control is dependent on power, variable returns, and the link between power and variable returns. Yes, that's right. And 93% of you got that right. Control is more than just a significant influence. Yes, that's also true. It's complete influence. So they control it and not only have a significant influence. So control is more than just a significant influence. Variable returns can be dividends, interest, and other remuneration. Yes, that's true. And variable returns can only be positive. Yes, you got it right. Only one picked it. Variable returns can be positive, negative, or both positive and negative. So that's why it is variable and not just positive returns. Okay, a non-controlling interest can enjoy variable returns. Yes, if you are invested in a company, but you do not control that company, you enjoy the dividends that are coming to you. So a non-controlling interest can enjoy variable returns, so that is correct. although they are not controlling it, and therefore they are not apparent. Okay, so number 7, which statement is correct? Under the interest theory, consolidated financial statements are set up from the view of the parent, which is controlling the group. Yes, that is exactly what the interest theory does. The next one is also true. Under the interest theory, non-controlling interests are considered to be debt. So when you look at the financial statements from the perspective of the controlling shareholders, then the others, the non-controlling interests, are considered to be debt. Under the unity theory, the financial statements are set up from the view of all shareholders. Yeah, that's just the other way of looking at it. So that is true. And when you look at it from the position of all shareholders, then of course the non-controlling interests are part of equity. That's just the result of how you look at it. So all the 4 statements are correct. Select the statements you agree with. The consolidation methods depends on the percentage of voting rights that the investor owns. Nope, that is not what you would look at. For instance, if you have the majority of voting rights, but you have a contract that you will not use those voting rights, and that another shareholder, which is a minority shareholder, has the power to organize the company, influence the operations, decide on the dividends and things like that, well, then it has nothing to do with the percentage of voting rights. And that is really, you should understand that, because that is the crucial point when you are looking at control. The percentage of voting rights is not the final point on which you would decide whether you control the company. You have to look at the facts and circumstances, and therefore it does not only depend on the percentage of the ownership. So the second is the correct statement, and please reconsider your answer if you did not pick that. The consolidation method depends on the type of investment. So in order to decide whether you control the company and you have to consolidate that, you have to look at what category of investment is it? Is it a subsidiary that is fully controlled? Or is it an associate where you have only significant influence? Or is it maybe just a normal investment where you have no control and no significant influence? That is the idea. You first look at the type of investment, and then you decide what consolidation method you will use. So the second one is the right one. And well, I'm really glad that nobody picked that one, because that would mean that the investor can choose which consolidation method they would like to use. Well, and that is not the case, of course, so that is wrong and nobody picked it. I'm really glad to see that. So select valid consolidation methods. Full consolidation, yes, that's for subsidiaries. We have the quota consolidation for joint operations, so that is a correct one. We have a normal, well, sounds good, but that is not a word, not a a term that is used in group accounting. So normal consolidation and also special consolidation is just nonsense. Of course, we have the equity method, which will be used for associates, and it will be used for joint venturers. So net assets will be consolidated via the equity method. And well, joint consolidation sounds good, but this is also no official term because joint arrangements are either consolidated by the equity method or the quota consolidation. It depends on the type of joint arrangement. Okay, I think it's not too bad, but I think some of you should reconsider their answers and go back to the slides and have a better understanding of what we did yesterday. All right, so I will close the poll now. All right, so welcome back to the second day. We did the first step in consolidation yesterday. We used this example of Ghana, this case study, to make you aware of what consolidated statements are and how do we come to those statements when we start at the single financial statements, so the statements of the parent, the single financial statement of the parent, and the single financial statements of the subsidiary. So we just put those two financial statements side by side in this matrix. So here is the parent, Ghana, and here is the subsidiary, Accra. We just, in the first step, we will just make a subtotal, so another column where we add all the figures that are here sitting side by side. So in the end, we have a preliminary column which could be used for the group accounts. But when we look at it, well, there are two things that are not really looking right. One is the investment, 300 here. There is no investment of the group in a subsidiary because we have fully consolidated that subsidiary. So it's no longer there as an investment. All the assets of the subsidiary, so like the tangibles here, are included in the other assets. So you see here, the 200 subtotal includes tangibles from the parent of 100 and from Accra of 100. So in total, it's 200. So this means that this investment of 300, which represented the net assets of the subsidiary, are included in all the other captions here. So the investment really makes no sense because you would have now the assets double. You have the net assets double in the subtotal. So in order to come to the group accounts, which is here in the last column, we have to eliminate the investment. So by giving a credit to it. And well, we also have to eliminate the equity of Accra because of the subsidiary, because that is also included in net assets, or that is net assets, and we have allocated all net assets to the subtotal column here. So that is why we would debit ordinary share capital by 100, and we would debit retained earnings by 200, just to eliminate the equity of the subsidiary. So when we do that, in the end, we only will show the equity of the of the parent, and that is really a check that you should do when doing such calculations. In the group accounts, you should only see the equity of the parent, and then you have made the equity consolidation right. So in the end, we will show group accounts that include, for instance, the cash at bank of the two companies. 200 plus 400 equals 400. So that is, I think, easily to understand. We have tangibles of 100 from the parent, 100 from the subsidiary, resulting in 200. We will show no investment, which is correct. The inventory is the result of adding inventory of the parent plus inventory of the subsidiary. So we will show 240 and so on. So in the end, we have group accounts with a total balance of total assets of 1,000 and total liabilities and equity of 1,000. So I think we got now a broad understanding of what consolidated financial statements are. We have really done one very simple example to understand what is in group accounts. And well, first is you just add all the numbers, and then you will eliminate those things that should not be there. And that is called consolidation entries. And as always in bookkeeping, we use debits and credits, and debits and credits should be the same, right? So otherwise there is an error. All right, so why are group accounts more meaningful than separate accounts? I asked you that yesterday, and I think your answer should have been, when you look at a group, then this group consists of one parent and at least one, and could have more subsidiaries. When you look at the single financial statements of the group's parent, that will not show much details relating to subsidiaries. So when you go back to this single financial statement of the parent, you can only see an investment of 300 here, not much more, right? And in the group accounts, you will see all the additional assets and liabilities, of course, of those subsidiaries included in the group accounts, which will give a better picture of the whole group than when you look at those two single financial statements. So the single financial statements of the parent does not show much details relating to subsidiaries. And when you look at the group accounts, there will be a lot of intercompany transactions or relations between parents and subsidiaries and other subsidiaries. So you can think of when you have a group, there will be a lot of purchases from from the parent. There will be a lot of sales from a subsidiary to other subsidiaries and to other related companies. So these intercompany transactions really are a transaction from the left pocket to the right pocket. And if you had only one company, you would not show sales from one department to the other department. So that is not externally generated revenues, and therefore you would not show it. And the same thing in a group. Remember, we said we will show the financial statements of the group as if it was one company. And if it was one company, the sales from one subsidiary to the parent or other intercompany transactions would not be shown, and therefore they will have to be eliminated. Same thing with management fees, rental expenses. Maybe you have sold something from the parent, so the parent has a receivable to the subsidiary, and on the other hand, the subsidiary has a liability towards the parent. So in theory, those two numbers should be the same, so they will have to be eliminated during the debt consolidation. We will look at that. And same thing with liabilities. Well, a liability and a receivable of intercompanies, they will be eliminated during the consolidation process. So I think it becomes clearer that the consolidated financial statements will have a clearer picture to the investors, to the shareholders, to the banks, to the public, and to whoever reads those financial statements of a company. All right, so when we do the consolidation, we follow a clear instruction, and Glendon calls these 5 steps that we will now look at the big 5 workings. So what do we have to do? Well, first is, well, we have to get a picture of the group. So what is the group structure? Remember this big example we had. We look at the group and find out who is the parent, who is a subsidiary, who is an associate, and so on. So we will determine the group structure. That's the first thing we do. Then we will summarize the net assets of a subsidiary. So that is crucial because when we look at the book value of the subsidiary, we have to value the acquisition, the purchased assets, as if we had bought them in a live transaction from a store, for instance. So we will value the net assets of that subsidiary at fair value. And then we will compare what we have paid for the subsidiary, and we will compare that with the net assets valued at fair value. And the difference, you know that already, is goodwill, or maybe badwill, or maybe a lucky buy. So we have to calculate the difference, and then we will have to determine the non-controlling interest, because those will be the difference between the percentage of the shareholders that own the group and the others that are just participating in the group via a non-controlling interest. Well, and then we have to calculate the retained earnings for the group, for the shareholders of the group, and put that also in the table. So these are the 5 big steps that we will use for consolidation. And we will put that data into a consolidation table, as you have seen in the previous example. And then we will just perform the math, and we're done. So Glendon calls these 5 steps the 5 big workings, W1 to W5. There might be more workings, so you will just extend the numbers. I think in our last example, we will have 9 workings, so W1 to W9. The share capital of the group will always be that of the parent only. So please keep that in mind as a check whether you have made it right. you can look at the share capital of the group, and that will be the one of the parent only. And retained earnings will be different in most cases because we purchase the net assets at fair value, and in the first financial statements, you will have book values. So the difference will go to retained earnings, and therefore retained earnings will be different. In our first example, retained earnings were the same because we had no difference. We had no hidden reserves. We had no goodwill that would have changed retained earnings, right? And I told you that is not normal. So please keep in mind share capital, check that. That should be the one of the parent only. Retained earnings, well, there are some differences that go into retained earnings, and we will see that. All right, so let's use the Ghana example again to work on that one. So when we determine the group structure, well, we draw a little picture. In this case, it is very easy, but I think we should start with easy stuff and then go a little deeper afterwards. So the parent's interest is 100%. There is no controlling interest, 100%. And Accra clearly is the subsidiary because it's controlled by the parent Ghana. All right, so what would we then do next? Well, we would summarize the net assets of the subsidiary. So at acquisition date, that means at year end, net assets are calculated as all assets minus all liabilities, and that is 600 minus 300. Or you could also say, well, net assets is equal to share capital plus reserves. So that is 100 plus 200. So either you take this equation or that equation, you end up with the net assets, which is equity of 300. Okay, so net assets are the same in this case, well, at the year end, because the acquisition date was at year end, so we don't have operations in between, we don't have profit from the operations and so on. So let's look at whether we can understand that. We go back to this slide where we have the consolidated financial statement of the Ghana group. What we did is we valued the Accra tangibles and inventories so that the total assets were 600, and that is at fair value, because there was no difference between book value and fair value, according to the facts and circumstances. And then we will deduct the non-current and current liabilities of 300. So we have net assets of 300, and that equals equity, which is ordinary shares 100 plus retained earnings of 200. Okay, so these are the numbers that I was relating to in this presentation. So then we have to calculate any goodwill. Well, the cost of the parent's investment is the purchase price. So you remember we have an investment in Ghana in the single financial statements of 300, and that was the purchase price, all right? So the purchase price of the Ghana investment is 300. We don't have non-controlling interest at acquisition, so that is 0. And we have the subsidiaries net assets at acquisition. So when we go back to this one here, we have net assets of 300, which is equity. Or we can also say 600 assets minus 300 liabilities equals net assets of 300. So we purchased those assets by 300. And when we calculate the goodwill here, then we will see there was no goodwill. So we paid fair value and there is no positive or no negative difference. So there is no goodwill, there is no badwill, and there is, of course, no lucky buy. Okay. But just to stay with that step-by-step consolidation process, we then go into the fourth working, which is we have to determine the non-controlling interest. Well, in this case, where we buy 100%, there is no non-controlling interest. So there are no minorities because the parent owns all the shares. And therefore, we just consider it as being zero. Then calculate the retained earnings of the group. Well, the subsidiary was acquired at year end. There are no retained earnings for that period. So we just put in the numbers. The parent's retained earnings were 240. So let's go back to Ghana. The parents' retained earnings were 240. And the parent share of subsidiaries post-acquisition profits, so these profits after the acquisition, but there is no after the post-acquisition period because the subsidiary was acquired at year end. And so there is no profit of the subsidiary during that 0 days, okay? So the retained earnings of the group is 240 at the year end. And that is what we just calculated here. The retained earnings should be the retained earnings here of the group. And it includes post acquisition profits, but as the subsidiary was bought on the last day in that period, there is no post acquisition profit. All right, so what we will do input the data into the consolidation table and perform the math. So we have already done that in the case study. Okay, I think that is also very important that you have that process in mind, that I can wake you up during the night and then you say, okay, we have to first determine the group structure. W1, we have to summarize the net assets of the subsidiary. Number 2. Number 3, we have to calculate any goodwill. Number 4, we have to determine the non-controlling interest. Number 5, we have to calculate the retained earnings of the group. And when we have all that data, well, then we just put it into the consolidation table and we're doing the math and then we're fine. Okay, so I hope that this little example gave you some idea of how the consolidation is done. It is one basic principle that you will apply E to the balance sheet, B to the income statement, and that is how you would come up with the group accounts. All right, now let's go a little bit deeper. So to speak, from the bird's eye view, we go now down to earth and look at the consolidation process. There are some peculiarities that you have to consider, and we will be looking at those now. So first, let's go to the theory, or more or less it's practice, because IFRS has some requirements for the consolidated financial statements, and we will have to learn what they are. We saw that VAS is using the same word, so I think we can well understand that one. So first, what is the purpose? What is the purpose of financial statements? Well, the financial statements, you can say they are structured. They are a representation of the financial position. So financial position means the balance sheet, the numbers in the balance sheet, and the financial performance that is relating to the income statement, to the cash flow statements, because that would be the financial performance of that entity. So the objective of financial statements is to provide information about the balance sheet, the financial position, the financial performance or the income statement, as well as the cash flows of that entity that is useful to a wide range of users in making economic decisions. So we understand users. Users are actual shareholders, potential shareholders, the banks, other creditors, of course, employees, the public, tax authorities. So there are a lot of users that want to have information about the company. The financial statements also show the results of the management stewardship of the resources entrusted to it. So when you look at the agent theory, you can understand that managers are given the power from the shareholders to work with the money that the shareholders put into the companies. And therefore, management has to get a lot of trust from the shareholders. And the financial statements also show that this trust is okay. Maybe you just got the information from the news that in Germany a big company, Wirecard, broke down, and obviously they have fooled around with the shareholders' money, and at the end, 1/3 of the balance sheet assets were not there. So I wonder how an auditor can miss that. Okay, so to meet this objective, the financial statements provide information about an entity's assets, liabilities, equity, income and expenses, including gains and losses, and contributions by and distributions to owner in their capacity as owners, and cash flows. So these terms are familiar with you because you already participated in my PACC course, so you should know all these terms. So this information, along with other information in the notes, assists the users of financial statements in predicting the entity's future cash flows, and in particular, their timing and certainty. Sorry. So that is the purpose. Well, then we have to define what is a CFS. CFS stands for Consolidated Financial Statements, and it is the group financial statements because they are consolidated, the group's single financial statements, because there are a lot of single financial statements in a group, as many as entities in the group. So if you have a group of 50 entities, you will have 51 financial statements, okay? 50 in the group, 51 financial statements. Why is that? Well, 50 financial statements, single financial statements, to be more precise, of the single entities. And then you have one group accounts, so you have a 51st financial statement, which is the consolidated financial statement. So in other words, you have one consolidated financial statement for the group and as many single financial statements as you have entities in the group. So what is the definition of a CFS? Well, the consolidated financial statements, they will show all assets, all liabilities, the equity of the parent, income, expense, and cash flows of the parent and its subsidiaries. And those are presented as those of a single economic entity. Remember, the group accounts will show the financial results and performance of the group as if it was one company. And that's a fiction because it is not one company. The group accounts just look like as if it was one company. In reality, you have, of course, 50 individual companies in a group. So what is the purpose of consolidated financial statements? Well, there is no difference in the purpose, the same as single financial statements, but it looks on the whole group. So CFS may be called consolidated financial statement, consolidated statement of financial position, or consolidated balance sheet, or consolidated whatsoever. So you can, there is no clear guidance of what the companies should use, but most of the time they will say consolidated statements, full stop. But they are not forced to do that. So you may see in practice other terms that are similar and hopefully easy to understand. Now, there is one very important principle in accounting, and that is called substance over form. I think we talked already about that when we looked at leasing. That is guided very much by substance over form. And the same is true for consolidated financial statements, because here the substance is used rather than the form. So I told you we will prepare group accounts following the substance over form principle. The group's accounts will be prepared as if the group was a single entity. So that's not the form, because the legal form says we have 50 entities in that group, and the substance says, well, they work together. They are following the guidelines, the commands of the parent company, so we should look at it as if it was one firm. And so we look at, for instance, this group here, which is a parent that has more than 50%, let's say 60% of ABC. So ABC is a subsidiary. And well, what are we doing? Well, when we look at the percentage, let's say 60%, we only own 60% of the assets, and we are obliged to pay only 60% of the, or we're not obliged, no? We're not obliged to pay the debt of this company, because when this company will go bankrupt, well, then the parent will still be there, if there are no bad consequences for the parent. For instance, the parent has some debt here and the debt will not be paid, so the parent also will go in trouble when the subsidiary is going bankrupt. But that is the view, and other view is that the parent controls even 100% of the assets, although they are not owning 100%. So that is, we look at this group as if the parent controlled 100%, and therefore we would allow that 100% of the assets will be put into the group accounts. Although from a strict legal point of view, the parent is not liable for the liabilities of the subsidiary, and it will not have the right to all of the assets because it only owns maybe 60%, as in the example. So what are we doing? We're not following the legal view. We're not following the 60% here. We're following an economic view. And the economic view tells us that the parent is controlling the ABC completely. And that is why we would put 100% of the assets and 100% of the liabilities onto the group accounts. Of course, there is, if we own only 60%, we have that 40%, which is called minority, and we would put that as a difference into the group accounts, and that will be shown as non-controlling interests. Okay. So what you should take away from this slide is that group accounts are substance over form. So we don't follow the legal point of view. So we know, yes, there are 50 separate entities, but we will look at it as if it was one company. That's the economic view, because they work together, they operate on the market together and things like that. And we also know that from a legal point of view, the parent is not obliged to pay for the liabilities of the subsidiary, although when you control the assets, well, I think in a going concern, you will understand that we also put the liabilities on the balance sheet of the group. Okay, so that is one assumption. Then we have relevant IFRS standards, and I just listed them here. So if you have some time and you want to know more, then you could go into those standards, or maybe use the Deloitte IFRS in the pocket. So you have a one-pager for each of these standards. So maybe you can have a look at that and do a little homework on that one. So IAS 27 is on separate financial statements. So that rules what has to be in the separate financial statements of those 50 group entities. So we have in a group of 50, we will have 50 separate financial statements. Then you have investments in associates and joint ventures. So that is IAS 28. We have IAS 31, which is interest in joint ventures. Then we have IFRS 3, which is basically the basis for mergers and acquisitions. So that is ruling business combinations. Then we have IFRS 10, which is ruling consolidated financial statements. So in a group of 50 entities, we have 50 separate financial statements and one consolidated financial statements. Well, joint arrangements is ruled by IFRS 11, and you have disclosures of interest in other entities, and this 12 is related to 10 and 11. So disclosures of interest in other entities are subsidiaries, associates, joint arrangements. All right, so these are relevant IFRS standards that are related to separate and consolidated financial statements. And then we have relevant IFRS standards that are related to separate financial statements. Well, I just told you, or let's go into it. IFRS 27 is on separate financial statements, and it defines the accounting and disclosure requirements for separate financial statements, or what we call is a single entity. And those should be accounted for at cost or at fair value. So when in the parent's financial statements, in the single financial statements, there will be an investment, that investment should be accounted for at cost. So that's the purchase price. In our Ghana example, that was 300. We bought Accra for 300 as a purchase price, and that was at cost. So if there was a fair value, for instance, this entity is listed at a stock exchange, then you would use the fair value accounting according to IFRS 9 in this case. So IAS 29 includes accounting requirements for dividends and contains numerous disclosure requirements. All right, then we have IAS 28, which is about investments in associates and joint ventures. So this is about the accounting of joint ventures, and I don't want to go into the details here. Same in IAS 39. You just should know that these standards are there, and if you have in the single financial statements, in the separate financial statements, when you want to know how to account for that in the parents' accounts, then these standards are the relevant ones. Now, for the consolidated financial statements, these four standards are the basis. Business combinations is the name for IFRS 3. And here you will see the accounting when a company obtains control of another business. So that's an acquisition or a merger. And that such business combinations are accounted for using the acquisition method, which generally requires assets acquired and liabilities assumed to be measured at their fair values at the acquisition date. So we know that already from PACC, but we will do some more examples on the acquisition method to find out what is the fair value of something that a company has acquired. IFRS 10 defines the requirements for the preparation and presentation of consolidated financial statements. So this is the standard that that requires parents to consolidate subsidiaries. So control requires exposure or rights to variable returns and the ability to affect those returns through power over an investee. So you know that already. Joint arrangements, IFRS 11 sets out the accounting by entities that jointly control an arrangement. Joint control involves the contractually agreed sharing of control, and arrangements subject to joint control are classified either as joint venture, so when you have a right to the net assets, or a joint operation that represents the rights to assets and obligations for liabilities, and those are accounted for accordingly. And IFRS 12 just has some rules on disclosures about 11 and 10. And that's it. So what is the objective? The standard says, well, the objective of IFRS 10 is to establish principles for presentation and preparation of consolidated financial statements when one entity controls one or more entities. So there is nothing with so there is associates are not mentioned when you have significant influence. That was the word I was looking for. So the standard only deals with control. So that is why we can also say there is a group. There is only a group when you have one parent and at least one subsidiary. We're not talking about associates in group accounts. But of course, we have to account for these, but that's only in a second step. All right, so the objective is to present and prepare consolidated financial statements. To meet that objective, well, it requires that an entity, which is called the parent, that controls one or more subsidiaries, present consolidated financial statements. So in a group of 50, we have to present one consolidated financial statement for the whole group. The standard defines the principle of control. We have already looked into that, and establishes control as the basis for consolidation. So you have to follow the consolidation rules when you have a group. It sets out how to apply the principle of control to identify whether an investor controls an investee and therefore must consolidate the investee. We have also looked into that one. Then sets out the accounting requirements for the preparation of consolidated financial statements and defines an investment entity and sets out an exception to consolidating particular subsidiaries of an investment entities. So sometimes there is an exception that you should not consolidate special entities, and that is also laid out in this IFRS. Well, and then this IFRS, so IFRS 10, does not deal with the accounting requirements for business combinations because there is a special standard for that, which is IFRS 3. So you should use IFRS 3 and IFRS 10 when consolidating subsidiaries. Okay, then I think the most important steps, and as we are in a university, you would not just learn that from a clipboard. So you just want to know where is the basis, and I listed the steps here and made a reference to the IFRSs. So what is the basis? Well, the requirement to present a consolidated financial statements, and under the and there are some exceptions you will find in IFRS 10 paragraph 4. The consolidation scope, so you have a global integration of all the businesses and entities in the world. This is in 10A. So there is no prohibition to include specific entities, no options to include or exclude specific entities. So in general, you have to consolidate all the entities, and the stress is on all entities. Components and form, well, you have to use a complete set of financial statements, which is set in IAS 1, paragraph 10. The applicable rules and simplifications is the same between a single financial statement and a consolidated financial statement. So in principle, they look the same. There are no differentiations between those. Of course, you will not show minority interest in a single financial statement. You will not show goodwill in a single financial statement. So there are some special things in consolidated financial statements, of course. And the reporting date is mentioned in IFRS 10. So basically, you should have the same reporting date. And if not, well, then you have to look up B92 in IFRS 10. There is another prerequisite. IFRS tells you that you should use uniform accounting principles. So you have the same recognition and measurement policies that is in 1019. Foreign currency translation is ruled by IAS 21. Equity consolidation, well, it says in the business combination standard IFRS 3 in paragraph 4, you should use the acquisition method. Elimination of intragroup assets and liabilities, equity, income, expenses, and cash flows relating to transactions between entities of the group. Well, that is laid down in B86C. So it basically says eliminate all intragroup assets and liabilities. So for instance, the receivable of the parent to a liability of the subsidiary. So those two groups, those two portions, one asset and one liability, will be eliminated against each other. Well, then there are some deferred tax rules you have to follow in consolidation in IAS 12, joint arrangements, IFRS 11, associates, IAS 28. And well, there are further components like the cash flow statement for the period. This is ruled by IAS 7, reporting of operating segments, IFRS 8, statement of changes in equity for the period, IAS 1, paragraph 106, and retained earnings per share, IAS 33. And then, well, at the end, you have the group management report, and that will be set on a voluntary basis. There is a practice statement, IFRS practice statement management commentary, which rules the group management report. In Germany, the group management report is required by law, although by IFRS this is voluntary, so that's an awkward situation. Well, the Germans have are requiring a compulsory management report, and if that management report is not delivered in the IFRS notes, then, well, the Germans say this is not comparable to HGB, which is our national accounting standard, and therefore we have to, or the company would have to prepare HGB numbers in addition. So that is the force to publish a group management report. But under IFRS, this is voluntary, and you will find this in this practice statement. All right, so I know it's a little bit boring, but I think it's easier to have all the references on one page, and that is really what you should take away from this. Please don't learn it by heart, because the numbers might change. Just keep in mind that there are some rules for the consolidation process, and I would like to give you those details. So maybe in future, when you have to do that in practice, it's an easy reference where you can go back to, and then have some help in what you have to do in practice. So I will not ask for this, can you please list the most important steps in the consolidation process and give references to IFRS. I will never ask that, because that is, I think, unnecessary knowledge. But you should know that there is something, and you will find it in IFRS 10 and so on. All right, so those were the most important steps. There are some exemptions. So a parent need not present consolidated financial statements if it meets the following and all the following conditions. It is a wholly owned subsidiary or is a partially owned subsidiary of another entity, and all its other owners, including those not otherwise intended to vote, have been informed about and do not object to the parent not presenting consolidated financial statements. So when there is, there is a wholly owned subsidiary, and well, all the shareholders agree that there will be no consolidated financial statements. So in that case, for instance, if Wiener Milk, I think not all of the shareholders will agree that Wiener Milk is not going to have consolidated financial statements. So if there is one shareholder who wants to have that, then it will not work. So, or its debt or equity instruments are not traded in the public market. So if you have financial instruments that are traded in the public market, then it will not work. Or it did not file, nor is it in the process of filing its financial statements with a Securities Commission. So that is the case when there is a big company that wants to go public and is in the process of going to be listed. So that is also not a possibility to have no consolidated financial statements. And its ultimate or any intermediate parent produces financial statements that are available for public use and comply with IFRSs in which subsidiaries are consolidated or are measured at fair value. So we have seen in our example, which we did first, what I called complex example, we saw that parent A sitting in Saigon was controlling several entities in the second line. And then when you looked at the second line, there were also subsidiaries that were parents at the same time, because those subsidiaries had further subsidiaries. So what you saw was you had a smaller group within the big group, okay? And if you look at the smaller group at the level of a subsidiary of A, then this rule here would apply. So if you have an ultimate parent, that would be A, and that A produces financial statements that are available for public use, and if they comply with IFRS, then the next lower level, the parent at the lower level, does not have to produce consolidated financial statements. So when I said you have an entity of, you have a group of 50 entities, you have 51 financial statements, that is only true when none of these group entities are listed. So when there is one parent at a lower level that is listed at a stock exchange, they of course have to publish consolidated financial statements on that lower level. Okay, and then the last note here on this slide is, well, based on materiality. So we spoke about materiality in our PACC course. We said that normally when there is something not material, then we will not talk about it because it's not relevant. So in this case, when a parent has one subsidiary, but the subsidiary is really after the comma, you have a lot of zeros, and then it's becomes a positive figure. So if that subsidiary is not material, then the parent will not present consolidated financial statements because they would look the same as the single financial statements. This is an exception based on materiality. There is no specific IFRS rule that you don't have to present consolidated financial statements if subsidiaries are not material. So you will not find such rule, but it is a general rule that we will look at materiality and therefore not speak about things that are not material. All right, I think before we, or maybe we can do that before the break. Let's just go into page 243 in the Daimler financial statements, and in the Wienermilch page 187. So let me see whether I can open that for you. Okay, it works. Good. So it's page 243. So let me enter that one. Page 23. Yes. And if I can manage to put it a little bit higher, you can see, well, what are the consolidated financial statements? Well, what are the consolidated subsidiaries? Then you have a big list of companies that are listed, and I'm looking for, maybe I missed it. No. You see still a lot of companies, Daimler-Benz, and it should come right. Daimler-Benz. Oh, this is a long list, I'm sorry. I should have marked. Here it is. That is what I was looking for. So Daimler-Benz Vietnam in Ho Chi Minh City is also consolidated because there is a it's a subsidiary because they have 70%. So there is a minority, a Vietnamese company holding the rest of 30%. I think that is according to Vietnamese law that you cannot hold 100% of Vietnamese company. So that is the list of investments. So that's rather a long list. Then let's look at Wienermilch, and I try to open the, oh, where is it? Okay, here it is. Yeah, okay. So that is page 187. So let's go to page, in the PDF file, it's page 94, because they have two pages on one page. And where is the list? Oh. Okay, here we are. So other information, page 187, is this 180? Here we have. How can we increase the size? Yep, okay. Other information. Here we have the list, the list of those companies that are included. So here they say we have related parties. Related parties means that there is a relationship between the Wiener Milk and either its shareholders or subsidiaries. And these are the companies or the related parties, the members of the board. All right, so in principle, you can see that consolidation in practice is comparable. So Daimler, of course, shows a long list, and well, Wiener Milk has also a list of investments and will say which companies were included, consolidated fully in the consolidated financial statements. All right. So before we then go to the consolidation process, I like to stop the recording.